Hello, folks. Welcome to Pro Trader Strategies. We're an educational company here, and we are doing a webinar series on swing trades using options. So, John, David, I'm glad you could make it. We've been going back and forth in the emails. Yes, this is the place to be on Thursdays after the close, or you could be on Facebook. So make sure you guys hit that subscribe button over there at the bottom. And there's a little bell there that will give you an indication if I come on unannounced. So I do that during the week when I'm talking about different trades. So make sure you have that link clicked so that you guys get notified. Also, smash the like button over there. That does help us out. It really does. And comment throughout this video. We're going to be looking over there at the side. I'm going to be making sure you guys are all clear of concept over there in the comment section. If you're watching this on tape delay, I do circle back around, make sure everybody's questions are answered. So thank you, John David, for showing up. But yes, make sure you guys click on that subscribe button. All right, folks, we are going to be talking about different option strategies. Right now, we are on the sideways moves, okay, and how we can take advantage of a trade or an underlying that just moves sideways in a boring market. There are opportunities out there all the time for stuff like that. We are going to talk about one of those strategies in particular today in this video. So throughout this, for some of you new folks, just so you know, I try to build from simple concepts to real life examples because I know options can be intimidating. So we are going to build from these simple concepts to these real life examples. And by the end of it, my goal is to have you folks understanding these options intuitively. And I think I can do that for you quickly. All right, so without further ado, let's get on with the overall webinar here on swing trades using options. Like I said, this is going to be for sideways moves. But before we start even really talking about the option strategy, which is going to be in this video, the long put butterfly. So usually when we are looking at an underlying, we don't specifically say, hey, today's the day I'm putting on a long put butterfly. I'm going to find an opportunity. No, what we do is we're looking at the underlyings. We see how the options are trading, whether they're expensive or cheap, and that ultimately is going to lead us to the option strategy that we're going to use to increase our probabilities of success, right? I mean, that's what we're ultimately trying to do, is turn the tables in our favor, and I'll show you how to do that with some of these different strategies here. But first, let's talk about swing trades. And really, what is a swing trade? I do have my shared screen there. You guys, last week we were having some issues. I switched some things around. I got the orange on today for caution because we're talking about the butterfly, which doesn't always follow exactly the rules that I'm looking for different strategies. And I'll show you how the butterfly morphs a little bit. So it's not specifically in line with what we normally look at for option strategies. And I'll show you those little nuances here as we go along. But what we're talking about with a swing trade is you need to find the overall direction of the market. And what I mean by that is whether it is overall bullish, right? We've got a bull. If we were looking at a trend here, market neutral, and like a bear trend right here, right? So then that is finding the overall trend, all right? After that, what we want to do is look at this underlying and see what's going on, kind of blur your eyes and find where it loses momentum on a rally and catches support on a sell-off. Those are your resistance area on the upside and support on the downside. We need to know where those locations are because that's where we're going to start looking for a pattern change. And the pattern change is, in this case, we've got a bull pattern inside of a bull trend, all right? And here we could look at something like this and a bear pattern inside of a market neutral trend, finding support and resistance. As you can see, sometimes we will find that those break through a little bit. And then on a bear trend, we can say we've got a bear trend, find our resistance, find our support, and then ultimately we are going to base the trade on the pattern within the overall trend, okay? So we're looking for that pattern. So some real life examples, what we could do is flip over to this one and just kind of blur your eyes and look at what this underlying does, right? And we can see that there's bit of resistance right along there and a bit of support there. Yes, it will sometimes break through, but ultimately what we're trying to do is find the overall neutral pattern, or sorry, neutral trend here. It's sideways trend in this underlying. We found support and resistances where we find it bump up against on the rallies or find support or buyers on the sell-off. Those are where you find your support and resistances. And then I look for different patterns like this, where we got this big doji and a confirmation right next to it for a rollover or that pattern reversal into a bear move. Again, another top there. What we would be looking for here is that candle. So I'm looking for candles at the top of moves that look like this, or, you know, in a separate situation like this, or they could be even green. Let's try and pull up a green one real quick. It's too hard to switch the other one. Or a green one at the top of a move. You know, they could be a tombstone doji where it kind of looks like that, or another hangman doji. They could be green at the top of that type of move there. This particular one had a red one. Now, aggressive traders might jump on this. It bumped up against the resistance area or very close to it. You know, it doesn't always tag it. And, you know, as a swing trader using stock or futures, I would probably be more inclined to wait for it to actually bump its head up against that resistance before entering a trade. But with the options, the beauty in it is that we can get strike location further away from where this underlying is trading. In this case, we could be selling calls up here at the 135, 140 area, okay? So that means that we would be getting short this underlying for, bearish this underlying, short deltas, not necessarily exactly short the underlying, but short deltas for a bearish move on this. But our strike location is much more conducive than selling right there at the underlying's current trading price. All right, another situation here. We can see that we've got a bullish trend and then the underlying breaking back into where we had found support in the past. And you can see that every time it's kind of bumped up against that support level, we've jumped up and away from it. So this would be looking at a bullish trend inside of a bullish pattern. And ultimately, if I was bullish in SPY, this would be an opportunity to take advantage of a bullish pattern. Now, we would have to look at some of the internals to decide what the ultimate trade would be for this underlying. If it had high implied volatility, I would likely be selling options, right, because of that premium, the higher premium. We'll talk about that here also as we go along. But a higher premium would cause me to think, all right, I've got a bullish move here. I would be looking to sell something like puts in this example here. If I thought it was going to maybe trend sideways, that would be a different strategy altogether. But I'm just, in this perfect example, I'm trying to give an example of a bullish pattern within a bullish trend there. Now, yes, what happens? Sometimes, like in this example where we could be looking at this topping pattern, a aggressive trader might jump on this, especially because with options, they think that they can get further away from it. Well, that is true, but still, we can see the underlying. If you don't wait for the confirmation, this one was not confirmed as a top, obviously, because the next day we got a big green candle on it and broke that pattern. Here, though, a situation like this, that might be the opportunity. It's the same type of topping pattern, but the next day that got confirmed. So that would be for a newer trader, especially if you're thinking about trading with swing trades or even options, wait for a confirmation, all right? I'm not going to always say that, but we are going to try to hopefully, if you are a newer trader, wait for that confirmation. I'm a little bit more aggressive. Aren't we doing the long put? Yes, this is the long put butterfly. If I said call, I did not mean to say call. This is the long put butterfly. I may have said something about the calls on that one example there, but this was just talking about trying to sell some calls or something like that. And then the other example with SPY. I'm just giving real life examples as to how to look at this and start determining your strategy there. Trying to get you guys to think this through a little bit. All right. So when we're trading around a swing trade, what is the first thing we need to do, folks? The very first thing you need to do at looking at a swing trade. That's right, the trend, overall trend, bullish, market neutral, bearish, all right? The next thing that we want to do is look for our support and resistance. Kind of blur your eyes and look where the underlying loses momentum to the upside and gains support to the downside. Those are your support and resistances, all right? And then ultimately, what we want to do is look for the pattern reversal or the pattern change, okay? So identifying the pattern move being this here on a bullish pattern inside of a market neutral bullish pattern, all right? So those are the things that we would kind of look for. The direction, yes, the overall direction. And then we want to try and see where that misdirection happens. We were trying to locate that for a swing trade. That is exactly what a swing trade means, right? Is the market's moving in one direction and it swings back the other way, or it's rallying and it swings back the other way. We're trying to take advantage of that momentum shift. All right? But why options? In this case, when I was talking about it, where we were looking at this example in IBM, I was looking at strike locations above this resistance area. I was looking at this strategy, folks, or this particular underlying for swing trades a while back. And this was an example we even used in those spot the trades type of morning videos that I do. And we actually got involved in this when it was on this confirmation as well. But if you were involved in this, got involved in here as a short stock in IBM, and this thing blew off to the upside, you would have been on your heels and panicking. But when we talked through this with the short calls in the daily market commentary, we knew that we had our strike location so far away from where the underlying was trading that, yeah, we did get tested on it, but it wasn't like we were going to get assigned on it or anything. It never came that close because of those options. When you say a pattern, you mean the doji. We're looking for, I'm not always necessarily looking for a doji, but those dojis do help for sure. But something like this where it breaks back into the channel we've gotten here, it's broken out. Now it's come back into the channel. That would be something I would look for too. But to answer David's question, the key candles that I really like to look for, something like this. This is called right there, that red candle right next to it. That's like a dark cloud, they call it, because it engulfs the previous days. So that would be a bearish pattern setup there. But really what I want you guys to do is look for candles that look like this at the top or at bottom of moves, right? Where the base of this hammer or hangman is, at the top, the hammer, right? You could have a spinning top, all right, or a tombstone, and they could all be green. It doesn't matter. We could have a green candle like that at the top, bottom of moves. Those are things we are looking for when it's got a little wick there or a tombstone, something like that, at the top or bottom of the moves, okay? So for a newer trader, those are things that I think that you should look for on those types of very, extreme highs and extreme lows. That would be an opportunity like this to take advantage of those swings. But those are basically 4 easy ones. And if it was at the top of a move, you obviously would want to wait for a confirmation. I'm a little bit more aggressive. I kind of look for those patterns and jump on them a little bit before they're confirmed. Sometimes. All right. And again, with the using these options, I was looking at this trade as well, not to throw everybody off. It wouldn't necessarily work for the butterfly because the assumption here is that we're going to start moving higher, right? So I've got a bullish assumption in here around this pattern breaking out. Well, everything going on around this underlying, the pricing in the options are really expensive. And, you know, if I could sell a put way down here at 115 at the point of control, that's a pretty long drop, right? Strike location. I would be willing to get long down here at 415. As a matter of fact, I think I was looking at the 415 strike, not necessarily 416. But to be able to sell puts down there, that is what I'm talking about. The reason why we would want to use options is because think about our strike location. Even if the underlying started trailing off a little bit, it would feel like we're losing money in those options possibly, but we're looking at it and knowing that there's a bunch of other support areas before we are ever really going to be tested on this strike or even have it trade around 415, okay? So that's what I'm talking about. Why we would want to use options in these different examples, right, is because we are able to increase our probabilities of success with this, right? In this case, what I'm talking about is the underlying starts coming off. I could still make money on this being directionally wrong, okay? And the only way to be able to make money on something when you're directionally wrong is using options, right? If you're out there doing futures and doing this, the underlying stock ETF, you're beholden to that price. So one of the things that I also like to talk about is when we're using options, folks, is that we can not only increase our probabilities of success, but we can actually decrease our risk, right? You know, the people that make the rules on how we can trade would say that going out there and buying a future is less risky than going out there and selling this put. It's a 16 delta. When we start talking about probabilities, that means there's only a 16% probability I'll be seeing my underlying trade 415 at expiration, right? So a 16% probability I'm going to be wrong. Those are pretty good odds. When you are buying and selling stock, it's a flip of a coin. It's 50-50. Those are your odds. Now I want to look at something for me for this particular underlying. I've got one of those dojis I was just talking about at the bottom of this move, right? I tried to zoom this in. Is everything a little bit more clear from last week? Some of you folks that were here last week, I changed the settings over there, so it's not 720, it's 1080. Sorry about that. So I've tried to increase the size so you can see it and everything. So hopefully everybody can see pretty good today. But you can see at the bottom of this move, we've got a bit of a hammer doji down there. So, and it's right at this point of control. Now, if you guys watch the Spot the Trades where I do every morning talking about my trades that I'm implementing, whenever we get to that point of control, it has a tendency to settle down, all right? Because that's where the most time and volume has been spent on the point of control. That tells us where the most transactions happen. And usually what we see happen with trading is when it trades at a price that we're all so accustomed to, volatility comes out. Why? Because there is no anxiety, right? If it's trading at a price you've seen trade for the last 6 months, there's not a whole lot of anxiety. Even if you're underwater on a short or underwater on a long, it just doesn't matter because it's still trading that price, right? So the markets have a tendency to settle down around these points of control, which is exactly what I would look for in a setup like this. It's right around that 50-day simple moving average. Yeah, some people could say that it's going to, sell off, maybe test this fib here or rally up and test that fib. Well, at the end of the day, it's right in the middle at the point of control, and I think it's going to stay within those areas, okay? Because I've noted the major support resistance. We could even say that this is a minor resistance area, even a little higher, minor support area there. So with all of that said, looking at this, even if I blur my eyes a little bit, if you kind of squint at it, it doesn't look like it's gone anywhere almost all year. all in that range between 160 and 140. That's not a very major move. And I want to take advantage of this underlying getting stuck in the mud. Before we talk about the option strategy, let's talk a little bit about these options, though, just to get some of you new folks a little bit more color on it and give you some easy ways to remember these. Now, think about it. The call buyer has the right, all right, but not the obligations. That means I can, but I don't have to buy the stock. The thing here is at the strike location, okay? Yeah, John David, just give me 1 second. So, for instance, if XYZ is trading, let's just say 100 to make everything easy, all right? And you've seen people buy calls. Let's say it's at the 105 strike, okay? So if you're buying a call at the 105 strike, you have the right but not the obligation to buy the stock. If this stock is trading 100, folks, are you going to buy or use your right to buy the stock at 105 when it's trading 100? No, you're not. You're just going to kind of let it go. But if XYZ rallied and shot up to 195, now XYZ is trading 195. I got a little aggressive there. So it's trading 195, right? That means I can buy my call at 105, right? Now, do I want to buy the underlying at 105 when it's trading 195? Absolutely. There's an immense value in that, right? So when calls go in the money and I have the right to buy it lower than when the underlying is trading, there's value in that. And as a matter of fact, those calls have to reflect that value. What I mean by that is when I buy a 105 call and it's trading 195, the underlying's trading 195, I own a 105 call. That call has to be worth $90 because the difference from 105 to 195 is $90. All right. There's going to be some extra money in there. And that's why I would say never take your right to buy that stock. All right. What I would say is you get out of the underlying, okay, or you get out of the strike, offset that trade because there's some extra value in there. So that 105 call when it's trading 95, there's $90 in value in there. There's some extrinsic value, maybe $1 or $2 even. So you don't want to leave that on the table. So cover the trade and go out there and buy the stock. You already offset yourself from basically 105 to 195, right? Because you've captured that value and a little extra, okay? So always better to offset that. That's right, John. It's got it, $90. So we want to take advantage of that extra couple of dollars and just offset the trade, go out there and buy the underlying. That money still goes into your portfolio, all right? Now, if you are the seller of a stock, you have the obligation to deliver it. I have to give you my stock if you say so, all right? So if it's trading, the underlying's trading 195 and I'm short at the 105 strike, I probably got about $1, maybe a couple of dollars for selling that. I get to keep that, but I also have to give him my stock at 105, all right? Because it will go into his account at 105. It will come out of my account at 105. All right. And then the call buyer has the right, but not the obligation to sell the stock. So if I buy a put, say at the 95 strike, because usually you're talking about below there. So at the 95 strike, I have the right, but not the obligation to sell the stock. And I don't want to do it when it's trading higher than where it is now, right? Because I can sell it higher than where it is, where my put is. But if the underlying fell to zero, there's immense value in being able to sell that stock out at a much higher price, all right? And the put seller has the obligation to buy the stock at the strike. So anytime you're selling those puts, especially if you're thinking about selling naked puts, always go into it with a mindset that I'm willing to buy at that strike, okay? And if it goes down there and you get long the underlying, Then we start staying mechanical, lowering overall cost basis. It happens to the best of us, folks. And I can't tell you how many times I have gotten long the stock and had to lower my overall cost basis on that trade. It works. I'll show you how I do that in the video. So make sure you check out those webinars on staying mechanical there. So the put seller has the obligation to buy the stock. All right. All right. When we're talking about options, you guys heard me talking about this pricing, right? A little bit about that here and there. If you buy a call, you have to pay something for that right. Okay. If you're buying an option, you have to pay for that right. And the seller receives that premium and he gets to keep it. You never get it back. He never has to give it up. All right. We do have to offset our trades though. So you might end up losing money, but at the end of the day, if you sell an option, you get to keep that premium. But how do we know if those options are expensive or cheap? I'm throwing it out here right now. Anybody know? We have to look at the option montage, and I've got Baba up here. I don't know why I've got Baba up there. Did these not save? Hold on, give me 1 second here. For some reason, those trades did not. All right, so what we want to do is go to this page. What is happening? I want to know where this underlying volatility coefficient is in relation to this underlying. So when we go over to the option montage, and I'm sorry I've got it up on the wrong thing here because it didn't save. But we want to look at this number, which is Vega, all right, or implied volatility, all right? We're going to see implied volatility in more places than we see Vega. They only threw Vega in here to make it look like it's a Greek, okay? It's implied volatility. Just know that implied volatility is forward-looking, all right? We've heard of historical volatility. That's what's happened in the past. Implied volatility is expectation of future volatility. All right. So I want to find out where 29 is in relation to where this underlying volatility coefficient has been in the past. Because what we find is that these underlyings will have a tendency to create its own like range bound type of area, just like in those swing trades. It's going to be looking more like a market neutral kind of volatility coefficient. But ultimately what we can see is that that's Baba trade again. All right, I'm going to have to go to this one. This is the implied volatility. What we need to do is have this chart at the bottom. So please discount that this is a Baba chart. But what we can see is that this underlying has a tendency to stay in a range bound. So go over to the chart, forget about that after you've done it, and get this implied volatility, because we need to know where this mark is in relation to the underlying. And in this case, you can see it. It's at the highest level it's seen in the last 52 weeks. Baba would have expensive premiums. In our case, we're looking at JP Morgan here. And we could see that if we draw a line, I like to discount everything that happened last year. I don't think that we're going to really see that kind of volatility going forward. Baba's a little bit of a different story there. But we can see that basically the last 6 months is what I'm going to be looking at for my support and resistances. And I am going to take into account this high here. But we can see that that's around 35. We've got 30. I'm just going to call it for easy math. And we're going to call this low right around 22. All right. Now we can see just by putting in my spacers there that I usually say up here, this is a sell zone, or you want to collect the credit. And this is a buy zone. All right. Where you actually buy these strategies. Okay. Collecting a credit is where I want you to take away from this, because anytime volatility is above that 50, we want to be collecting a credit, right? We want that to be the main focus of our trade, all right? That collection, all right? Because we want, when volatility is at these extreme levels, that volatility to come out, right? So when it gets up there, we want it to kind of start coming out. Why? Because as volatility increases, our premiums increase. For every 1 percentage point increase in this volatility coefficient, my premiums are going to increase, all right? So when they are at these extreme levels, we know that those premiums are expensive. And when they are down at these lower levels, we know they're cheap, okay? That's the only way to start turning these tables in your favor. You do not want to be buying options when they're extremely expensive, right? You have to be a good steward of your capital. So if you want to really look at the devil in the details, really what you do is you take the current implied volatility minus the low. So basically what we're trying to do here is find where the current is in relation to that low. How far away from that low are we? Okay. Current minus the low, and then you find the full range. All right. And divide those sums by each other. So the current, we've got 30 minus 22. Take that sum and divide it by the range, which is 35 to 22, right? So basically I've got 8 divided by 13, and that's going to give me around 61.5. All right, so it's in that upper band. All right, if you guys want the script for discounting what happened last year, I've got that. You guys will just have to reach out to us. All right, so I know that these are expensive options, right? Because I've determined that that volatility coefficient is in the upper band of the range that we've seen, all right? So normally what do I say? Well, if options premiums are cheap, we want to be buying those. And when they're expensive, we want to be selling those, right? Not necessarily the case with this one, because we are high volatility. We want to exploit theta decay, not limit it, all right? When you're buying options, you want to limit that theta decay. When we are selling options, we want to exploit that theta decay. Some of you folks might be thinking, all right, well, we were talking about long. Well, with the butterfly, remember, the long butterfly, whether it's the call or the put, usually when we commutate long options, we need a big move to happen. I talked about that a little bit earlier with you buy a call, you want that thing to move, right? Well, with this option strategy, the butterfly morphs a little bit, because ultimately what we will do is it's going to be a long butterfly, but we make our money on the short strikes. And I'll show you how that works out here. So we do want to take advantage of the thief. Anytime you have high volatility, you want to take advantage of that thief, because the collection of credit is what is going to make the strategy work. So if we're taking advantage of that thief, we want to get inside of, I usually say inside of 45 days is really the sweet spot. Get involved 45 days to expiration. All right. We're inside of this 35 days, which is fine. You can see further out here that levels out a little bit. It's not linear. It's not a dollar every single day. What we see here is that it starts ramping up and gets really aggressive the closer and closer we get to expiration. So when your premiums are expensive, you're selling options, you expect that volatility to come out. Well, you want theta on your side too, because every single night theta comes out and picks your pocket. You can't stop theta. You can kind of offset it a little bit, but you can never, ever stop theta from eroding premiums, okay? He's always going to come in there and try and steal your premiums. And we could see this show up in the option montage. And SPY, I did this because it's a high dollar stock. But what we can see here is theta, 120 days to go, and this is our theta on the calls and our theta on the puts, all right? Now, theta is always negative because you cannot stop it, all right? It's negative on both sides. But we can see out here, 120 days to expiration, we only have 7 cents of theta over there on the calls, 8 cents on the puts. here we can see it increases by a couple of pennies over the course of 80 or 70 some days, right? This increase, so you can see it's starting to ramp up a little bit, but then look, that's 80 days difference, right? We got, let's just call it 80, it's 50, so it's actually 60 some days, right? 67 days. So 60 over this course of 67 days, we see it increase. We get a +2 on our theta. All right. Now we go from 50 days to 30 days. So now we're, close to 30 days. It's less than that. And look how much our theta is increased there. Now this is the wheelhouse we're looking for. We want this to happen to our theta. It over doubles over the course of the next 20 days. So you can see this theta is really ramping up. 30 days, it only increased 20 some, or sorry, 60 days, it only increased 2 cents. The next 30 days, it increases up 4 cents. And then here it increases another 12 cents over the next 20 days. So it really starts speeding up, and you can see that show up over on the put side as well. Okay. I want to make sure there's no questions. For some reason, my thing blew up. All right. So if I bought the 100 put, if the stock is at 105, shouldn't I be forced to sell the put? Right. So if I bought a put at 100 and the stock is at 105, shouldn't it's you were tried to type so fast I can't read it. Be forced to sell. I don't know. I can't read that. I'm trying to decipher that, John. You might need to retype that. All right. So the volatility barely increases above 50 mark, but is steeply increased. Should we still sell it since it will climb further? Zeke, great question. If you expect volatility to increase, then no. All right. I don't expect volatility to increase in this particular situation because it was right there at that point of control. So my expectation is volatility is going to immediately start coming out now that we're there. If you do believe it gets just above that 50 mark, and especially if you have a lower risk tolerance, wait for it to get to more extremes. Maybe above 75, that's something I would say. Usually I say if you have a pretty decent risk tolerance, above 50% you sell, below 50% you buy. If you have a lower risk tolerance, I would say 75-25. Use your extremes. Does that make sense? Yeah, we good there? All right. Let me erase all this real quick and then get back to that. So if I bought the 100 put, if the stock is at 105, I'd be forced to sell the put seller at the lower strike. If you bought the put at 100 and it's trading 105, you're not going to be forced anything. You're not going to force anybody anything either, right? If you bought a put, you would want that underlying to be below where your put is. All right. So something about this long put here with this strategy. We know we have that high implied volatility. I'm expecting the volatility in this underlying to start settling down. I want to take advantage of that volatility coming out. Believe it or not, we're doing the long put butterfly because of the strikes at the money. Those are the ones we're selling. All right. And then we're going to buy an in the money option. That one is the one that's going to be really expensive. So that one that we're buying ends up making us pay a debit for it. But I'm going to show you how we take advantage of this strategy with the volatility and the theta coming out here in a second. So with this strategy, I've got a neutral market assumption, high volatility. I expect us to settle down right around that point of control. I want to try and take advantage of an underlying trading basically in here. I think that my JP Morgan is going to trade within this range, okay? And what we know is that if we add up all of this, this is, oh, sorry, I want to go to, yeah, right there, the one right just inside of here. But if we add up the 9, the 4, the 1, 0.2, the 0.5, the 1, all the way out, basically what we see is this is about 16%, all right? And this is about 16%. So we expect this underlying to stay within a pretty, that's basically 10% up and 10% down for the most part. So we want to be able to have this underlying stay within that range with defined risk, right? So with that said, I'm going to be looking to trade with using the long put butterfly. Something with delta is, it's the rate of change in an option premium. Just kind of like what we talked about with volatility. Volatility increases. Volatility just tells us that if it increases 1 percentage point, our premiums increase by the corresponding amount. This is saying if the underlying moves higher by $1, our options premiums change by that amount. But it's also delta, or sorry, data. Delta is also data because it tells us the probabilities. When I'm talking about delta, you've heard some people probably even on TV saying it's about a 15% delta. Well, that's about a 15% probability. So when we're looking at delta as delta, it also is the percent probability of being in the money. All right. So when we're looking at this one, we want to look at our option montage. I don't know why that's not coming up. Where we are doing these same strike. So ultimately, we have a long put. We have a long put spread and a short put spread, jamming them together to create the long put butterfly, okay? So these are going to be the same strikes. You can see I put a 50 delta in there. You're just going to try and sell these two as close to a 50 delta put as you can. It's not always going to be exactly 50 delta put, folks. And then you're going to go out to around an 80 delta in the money put and an out of the money 20 delta put. Those are just to give you ballpark figures here, folks. Ultimately, you want to do this. You don't want to pay any more. So if your debit is equal to a third and no more, third to a half, all right? No more. I would prefer paying no more than a third the width of the spread. Sometimes it gets up to close to a half. You're going to have to be really sure of the underlying staying there. But around a third, sometimes you can get a little bit lower than a third as well. But ultimately, I'm looking for a third the width of the strikes, right? So, you know, when we're talking about that, a third the width of the strikes on a $5 wide, we're talking about $1.50, right? $2.50 wide, about 80 cents, right? So if I'm going to set this up, I look at it. I'm selling the 55 puts here, which is right at the money. You can see it's close to a 50 delta. It's not exactly. So I sell 2 of those. And then, you know, I'm looking at going about 10%, all right, away. So if you have a $150 stock, what's 10%? $15. $100 stock, what's 10%? $10. $50 stock, $5, right? Got the gist? That's a good way to judge this. And you can see that my in the money is a little bit more than that 90 delta and the 45 strike, 65 is the 90 and the 45 is the 20. So it's a little bit skewed there. It's not, like I said, always going to be the exact ones, but we can see here it's right around a $4. So I got this one just slightly less than a third the width of the strikes, right? Because I've got $3.94 and I've got $10 wide. Actually, it's about 40%. Sorry. So it's right in between that third the width of the spread. I thought this was $15 when I looked down there. Sorry. So it's right in between that third to 50% the width of the spread. That's pretty good. on a strategy like this. Now, some people might be asking, are you going to do anything with this underlying if it starts really moving? I've got defined risk on this, so I'm not going to. I know I'm risking 1 to make 2, so that's what I'm trying to get here. Therefore, they're in my favor. Yeah, Zeke's saying, I think you have a reverse from the calls and the puts. I do want to. I was getting confused myself. When you sell a put or a call, you are obligated. Yes, you are obligated. If the buyer wishes, the buyer has the right. You are so if you sell a call, you are obligated to give it to them. All right. If you sell a put, you're obligated to buy it from them at those strikes. All right. So for instance, when I'm talking about here, if we're just looking at the option montage, right? If this call, the 45 call, right, is in the money. If I own that call, I have the right but not the obligation to buy the strike at 145. It's trading 155, right, or 154. My 145 calls are in the money by over $9. I have to be paid at least that much. That has to be at least worth that much. You can see they're worth $10, $11, so more than that. That's why I was saying never go through your right. I want to buy this at 145. I'd be leaving $2 on the table. Okay, right? Because that call is only worth $9. 145 to 154 is $9. It's trading $11. Don't go through the assignment. You lose $2 on that trade, right? If I assign, I'm also paying all this money to go through the assignment. Don't do it. Offset the option. Go out and buy the strike. Really, you're giving yourself $2 by doing that. So you can think about it as I get out of my 145 options. I don't get to get long at 145. I'm getting long at 154, but I got $2 extra. That means I lower my overall cost basis, right? Same thing with the puts. If I bought a put at 165, I have the right but not the obligation to sell that stock at 165. There's an immense value in selling the stock at 165 when it's trading 154, right? $11. Well, you can see this one's just slightly off of that $11, but it's still money. I mean, you leave $50 laying on the floor? No. Right? So make sure you just offset your options. And if you really wanted the stock, go out there and do that. You're saving, you're actually making money that way. Right? Now, when do I get out of this trade? Like I said, on this trade, because it's defined risk, I'm going to go try and find my JP Morgan chart. I'm going to, with my strikes, I'm range bound on these areas, $10 up, $10 down. Well, you can see if I throw in a couple of lines, 165, basically we're talking about that 165 strike and the 145 strike being down in and around, oops, a little high, but you can see even with this as being resistance and this as being support, I'm still within that with my defined risk, all right? So with this trade, I'm going to probably let this thing ride out. I'm risking much less than I'm able to make on this trade, so the risk reward is good. Plus, I think that this point of control is going to hold. Even if we break down to 141, I would expect it to want to drive back up to the point of control on this trade, okay? So on this trade, when do I get out? On a loser, I'm going to try and ride this out. And for the max profit, remember on the max profit of this, I'm paying out $4. My max profit is $6. All right. I am likely to get out of this trade at around $3 winner. Right. So if I paid $4 and my total profit is $6, I only want to take half of that massive profit. So I'd get out at around $7. Right. About half of my max profit is what I look for in this one. And the reason why is because These butterflies, folks, will take a very long time to mature. Just kind of think about it as you put this trade on, you're going into a cocoon for a while. All right. So stay away from that. John, how do we prevent the assignment to save the $2? Hold on a second. We'll go through that at the end here. We'll break that down. So if anybody is a little confused, we're going to go a little longer today to make sure we hammer this out. So I'm going to get out at 50% of max profit. That's what I'm going to look for. So in this case, I was looking at $10 wide, right? I'm just going to say I paid a $4 debit. So my profit, my max profit is $6. And I'm going to go 50% of that. Okay. Now, if we go over and look at the Analyze tab on this trade, you'll be able to see, maybe not. There we go. It's the Baba trade again. Why didn't anything save? You guys are killing me. All right, I know I screenshotted all of this stuff and put it on here, so I'll just go find it for you real quick. Give me 1 second. Analyze tab for JP Morgan. I know I did it. There we go. Here's the trade I've been looking for. All right, so the JP Morgan trade, we can see that's at $4 here. Our risk is that debit. Our reward is the difference. So up to that $600 that we were talking about, $604. And then if we go over and look at the, what was the thing I was struggling with, the option Montage. The 39, and then on the chart for that option Montage as well, the chart. And here's our chart. Coming back down to that point of control with the high volatility. Finally got all my charts. For some reason, they didn't save on that PowerPoint. I'm sorry. Anybody else have any other questions on this? But ultimately, here's that trade, trying to go through all those because the option Montage was kind of messing me up. But we can see that also that this trade with the option Montage is very similar to the iron butterfly or the call butterfly, the long call butterfly. Now, when we're going to use the long put butterfly, we want to use that long put butterfly when we have options that are skewed to the downside, has more premium in them versus the ones to the upside. That would be the major difference here that I would look for in this trade. And we can see on the option Montage trade that we do have a little bit of skew to the upside here. As you can see that these 155 puts are much more expensive than the 155 calls. And that's because, well, for one, they're slightly in the money, but there is skew to the put side here. So selling these options right here, we're selling 2 of these 155 puts, folks. And those are at the money. And then I'm buying this 165 puts, right? Now those 165 puts are in the money and they are immensely valuable. Remember I talked about from 165 to 154, there is basically what, $10.50 in there? Difference between 165 to 154, or $10.50, right? That's the difference. And these are trading $11.30, right? So we can say that there's about 80 cents of extrinsic value. These in the money options have to hold on to their intrinsic value, which is what makes them valuable, right? The difference between 165 and 154.40. My option that is in the money has to reflect that difference. if not more. All right. And there's usually more in there because of time decay, that theta. That will still erode, but there's only 80 cents in it. An easy way to look at your extrinsic value is look at the your in the money options, look at the corresponding options. You can get a quick, dirty, it's not exact, but it gives you a ballpark of it. You can see that that's 80 cents. So if everything decayed worthless on this trade, right? My 145 calls that I got long, all of that is extrinsic value. That goes to zero, right? This goes to zero because it's 82, right? I lose that 82 cents in this $1.40. So I've lost a total of $2.20, right? On those ones that I bought. But these at the monies, if it stays right there, if this underlying is trading basically 155 at the end of the day, 155.01, those options expire out of the money, right? This option, if I get a little bit of a move to the upside, my puts expire out of the money or will be out of the money. Out of the money options, even if they're a penny out of the money, are worthless at expiration, right? There's no interest, there's no value in being able to buy something or buy it. You can't get it lower than where it currently is there. All right. That's what I'm trying to say. So if the puts are out of the money, just slightly out of the money, underlying's trading slightly higher at 155.01 at expiration, those 155 puts are going to expire worthless, right? Because you could always sell it higher if you wanted to, and nobody's going to assign you that close. So these puts would expire worthless as well, or with very little value, okay? Because all that's going to be left is the intrinsic value of that option once all the theta decay has gone away. And we could see that that would be $4 times 2, because I'm doing 2 of those. I'm shorting 2 of those. So that's where you make all the money, is on those short 2 options at the money that are filled with theta and volatility. Another thing we can see is that when we were talking about the Vega or implied volatility here, we can see that implied volatility affects the closer to the at the money options more so than these ones that are further out of the money, right? So if volatility collapses, then those at the money options are going to decay faster, all right? And we can see that theta is more aggressive on the options that are at the money than the ones that are further out of the money. It's not dramatic in this example, but on some of those ones with the high dollar stocks, you'll definitely see that difference more exaggerated. But you can still see these ones that we're selling, we would be selling at the money, are going to decay just due to theta 2 to 3 times faster. So we want to take advantage of that. So selling this butterfly, we've got a lot of levers and pulleys working in our favor, right? If we're right and it stays right here at this underline or at this strike price. Those 155 calls, I'm short 2 of them. Those are filled with volatility and theta. I can take advantage of that if volatility comes out. All right. Does that make sense? I'll jump back over there. How do you prevent the assignment to save $2? Can you... I don't understand the strikes when the price of JP Morgan is at 154. The short strike is already at the current price. Yes. What's that rationale? I want to use in the long put butterfly. The only reason why it becomes a long put butterfly is this 165 put that's in the money. Because I have to buy that one to define my risk, right? I'm short 2 155 puts. I buy one, the 165 put to define that risk on one of my short puts. That one is in the money, and I have to pay up for that, right? I'm paying $11 for that. That ultimately is what makes this a debit. But I make my money off of the theta decay and volatility coming out of these premiums, and more so at the 155 strike. Those are the ones I'm short, right? I'm short 2 of these 155 puts. That's where I've gotten the most money, $8 and almost $9. So I collected almost $9 here selling 2 of those because I sold it twice. Buy one of these I'm only paying $1. I'm still short like $8, $7.50 or something. And then I go out here and buy this one. That's where it makes it a debit, right? That's what makes it a long put butterfly, is because you're paying a debit. Anytime you're paying a debit, it's long, right? But because it's a butterfly and I'm short 2 at the monies, it's morph. I don't want a big move on this long one. I want everything opposite. I want high volatility on this long one. I want volatility to come out. I want theta to come out, because of those 2 short at the monies that will have the most amount of theta lost. Does that make sense? Or most amount of premium lost, if we're right. You know, if the underlying just free falls and blows out to the downside, well, then they all expire worthless, and then I'm going to lose money on the ones that I paid up for, those in the money ones, right? If I get a big move. John, did I answer your question on the assignment? How do you prevent the assignment? I'll let you answer. Move on one more time. I'll let you type in there. I'm trying to make sure everybody's clear here. All right, so guys, if you guys want to take advantage of this, here is your opportunity. This is the options course that we're going to be offering today for you folks. What we're trying to do here is get you guys introduced to options. Literally, this is building you from the ground up, where we're going to be talking about the point of control, the option montage over there in the options, where we go and break down all of the different Greeks. We're also going to talk to you when, where, and why you can use different option strategies. The market profile is a great one. You guys heard me talking about that market profile. I trade around that thing all day long. And for $36, like, if you guys have been buying options in high premium and not understanding why you're losing money, I just saved you that easily by selling you this course for $36. Here is really everything that goes into it for $36. That other was just a brief overview. 310-598-6677, and reach out to us, folks. If you have any questions, comments, or anything else, please reach out to us. Even over there in the comments section, I'm going to circle back around for you folks that are watching this on tape delay. Please subscribe so you guys get notifications when we're hitting these videos, doing them live, and when I come in on announced. Finally, smash that like button for us. It really does help us out. And I'll throw the link over there in the chat window. Give me 1 second here. Try and deal with my computer that's giving me fits. It's really quite interesting. This whole, give me 1 second. I'll try and flip it over there for you. John, I'll get you just a second. Give me 1 second. There is the link to the course. It should be a hot link. You guys can take advantage of that. Click and link on it. Also, you can reach out to us at trading@protraderstrategies.com. See a couple questions popping on here. Let me try and see. After this course, if you guys buy this course, you guys have unlimited access to this. So in a sense, where I was showing you this page, if you watch a video, literally we have little boxes in there and it checks it off for you, like you've watched that video. So you have all the time in the world. You don't have to go in order. You can pop around, watch them more than once, but once you paid for it, you guys have unfettered access there. And there's some fun ones in there as well. All right. So let's look at John David's question. After this course, which one would I recommend? You know what? That's a great question. After this course, I would go to the earnings one. And that's only because we're kind of coming out of earnings. So you can get set up with high probability strategies, longer duration, especially if you're newer to options trading. It's more along the lines of buying longer duration, selling, getting you comfortable selling some shorter duration against longer duration. So you don't have to worry about IRA and all of that stuff. And then it gets you ready for the next earnings season, which literally is, we just exited for the most part the earnings season, and we got Lulu right around the corner here. So it'll get you enough time to watch those videos and be prepared for it ahead of time. Does that make sense for you, Alina? The earnings courses, yes, the earnings course is the one I would look for. All right, John David. So that's the end of the course, guys. If you guys want to check out the link, like I said, it's over there. But if you want to stick around and hammer this out with John David and I, you are more than welcome to stick around. All right, John David. So let me look at the option montage if I can find it. Here we go. Where are all those pictures I just had up? There we go. I don't want that. I want the option montage for this trade. All right. Can you guys all see this pretty good? All right. So John David, I'm going to use this as my example because I think this is the one we were kind of looking at. Let's look at the 155s. All right, here, I'll do the white one. The 155s. All right. So if I buy a 155 put, that gives me the right, but not the obligation to sell my stock at that price, right? Now, I would love to sell this underlying at 155 when it's trading 154, right? I can sell it higher by 61 cents, right? There's 61 cents there that I could literally make money on. But if I bought it in order to have that right, I would have paid $4.30 for that, right? So it doesn't make sense for me to do that right now because I paid that $4 for the right to sell my stock at 155. Well, it doesn't make sense right now, does it? I can sell it at 154.40 and save myself $3.50, right? Because I'm selling it below. It'd be 155 to that, 61 cents. I lost that if I just go out there and, sell the underlying. Does that make sense? Am I answering your question? So there is only 61 cents of extrinsic value or intrinsic value in the 155 put. The rest of that is extrinsic value. The other almost $4. All right, with the Vega it's 0.17 or 0.7, that's this. So that means so when we're looking at this, that's talking about 1 percentage point move. So if volatility increases by 1 percentage point, my premiums will increase by this 17 cents. All right, so 1 percentage point increase, we would see this bid be 447, right? And the offer would be 450. What did I say? 17 cents for. Sorry, 462 or something. So the rest is extrinsic value. So if I sell those two, I want all of that to be the extrinsic value I lose. Yeah, so I'm selling the 155 puts. Nobody is going to assign me on that because of the value. If they're buying that 155 put for $4.50, they aren't going to assign me on it because it's 11 cents in the money. They're not going to. That wouldn't make sense, would it? You buy it for $4.50 to sell it 50 cents higher than where it is. That doesn't make sense, right? That's why we want to sell those ones that are right there at the money because they have almost no intrinsic value and almost all extrinsic value. So if we see this underlying trading right here at expiration then we're going to see all of that theta decay come out of everything, or volatility. If the volatility just free fell, then all of that premium would come out of those at the monies, and I'd be jamming. Right? Okay, theta is 0.4, right? Theta is 0.4, so that means you lose 4 cents per day off of those premiums in the option montage. Yes, theta is always negative, so when we see theta, wait, what were you saying? 7 cents? Or not? Or yeah, theta is 7 cents. You earn 7 cents a day coming out of these premiums, right? Because it comes out, I've sold those. My position would increase 7 cents per day on this. Now in my portfolio, it's going to look like 100 times that. So 7 cents is actually $7, okay? But that's over in your portfolio. But 7 cents would actually come out of these premiums tomorrow if nothing else changed. So basically the trade is you're hoping for this underlying to stay right here. It's a butterfly, so all the rules are thrown out the window. You're long, which makes me think I got to have an expanded move or an outpaced move. But not with the butterfly. Just always remember, if you hear butterfly, it's morphed. Long means short. Short means long, right? It's different. It's a beast altogether different, because with this butterfly, I'm selling 2 of those, so I collect $4 for each of those. I'm buying this one with almost no theta decay, so I hope that retains value, right? And if that retains value and everything else loses all of its money, then the one that I'm long that retained that value is the one that I make the money on. Or it makes it look like that. It's actually selling these options that is ultimately going to be the thing that makes this profitable. Those too short at the money's working themselves out. All right? Cool. All right, well then without further ado, I'll let you guys go. I appreciate it. Remember to click on that link over there in the chat window if you guys want to take advantage of this. And if you've already done that, cram through that. Earnings one would be the next one I would go for. If you are a very new options trader and you're really looking at the basics, go to the options basics. You know, I don't know what your risk parameters are or how long you guys have been trading, but the starting out from the very basic option strategies and building on those is a good one. Okay. All right. Make sure you click on the subscribe, that bell down there, like, thanks, comments. I'll circle back around, but without any further ado, I'll get out of here. If you can't take that, take it easy.